Thank you for the invitation to be here with everyone. Yeah, so what I tell folks is that, I was a lifelong Washingtonian. So despite my youthful appearance, I'm actually on the wrong side of 40. So I was in Washington for just about 40 years and then made the move to Boise a little over a year ago. But in that time, went to Seattle Pacific University for college. I was actually on the board of SPU the last 3 years as well. But out of school, I cut my teeth in banking. So I worked at Washington Mutual. I'm sure everyone knows of Washington Mutual, but they're a relic now. So I was there from 04 to 08 in like a strategy role. So I guess in some ways you could say I did very poorly because my strategic involvement didn't help. But all that to be said, I was doing capital markets, kind of corp dev strategy type of work there out of college, which was really fascinating. I really enjoyed that. And then I left a few months before they were seized by the Fed. So I saw the writing on the wall that something bad was going to happen, but I didn't think that was going to happen. I actually just thought they were going to get acquired by a larger company. So, having worked at big companies, so I worked at both, like I said, Washington Mutual, then I had a stint for several years as a portfolio manager at Eaton Vance, which is a big fund. They were out of Boston. I think they were just acquired by, I think it was Morgan Stanley, if I'm not mistaken, doing portfolio management there. Then worked at Microsoft for a number of years as well, doing similar corp dev, capital markets type of activities, share repurchase, making acquisitions, dividend policy analysis, things of that nature. So I did a good stint in kind of that big corporate world, but kind of post Microsoft, I worked at a boutique firm in Kirkland that was doing both investment banking and private equity acquisitions. So that firm was called One Accord. And I was a managing director there, worked there for almost 6 years, and really, really enjoyed that line of work. Enjoyed both the components of, serving business owners that had put their blood, sweat, and tears into their business for potentially decades, and looking to actually help them exit and get that big liquidity event that was years worth of in the running. And also just deploying capital. So doing the due diligence, finding opportunities, unearthing them, and then actually acquiring companies and then helping run those companies post-acquisition. So that was a fun job. But when my family and I felt it was time to leave the Seattle area, I had resigned from that job, told them that there was a couple sell-side deals I was going to continue working on, but I could do those whether I lived in Washington or Idaho. And then, like I said, made the leap of faith to Boise 18 months ago. Okay.
And how are you enjoying kind of transitioning to more into early stage investing?
Yeah, it's really unique because there's transferable skill sets in doing both investment banking and private equity. But what I think I'm enjoying the most is kind of twofold. One is putting our money where our mouth is to say like, hey, we're betting that this company is going to do well, even though it's early stage, even though there's a long horizon, lots of things still to actually happen down the road. But having that kind of aligned incentives with the founder entrepreneurs has been gratifying. But even more so, I would say, is we're not a typical investor where we want to kind of spray and pray or make an investment and then kick up our feet and say, hey, I hope that works out well. Like what we enjoy about doing is rolling up our sleeves post investment and actually helping that entrepreneur founder realize their vision, to be able to add value. And I think the earlier stage of the company, the more significant that 1, 2, 3 degree shift is for the trajectory years down the road. So that's, for me, has been the most gratifying part of it. And it's just been great being able to add value and have incentives aligned, and obviously wanting the companies to do well.
Yep, well, I can certainly share that sentiment. It's very rewarding to be at the early stage when there's still a lot of chaos and the decisions that you make are really impactful and kind of set the DNA for the success or failure of the company down the road. You're not the only one on the team at Capital 11. Who are some of your other partners, and maybe even talk about kind of the structure of your firm, because you're not a traditional VC firm that is backed by pension funds and insurance companies and of the sort.
Yeah, that's definitely true. And yeah, it's unusual, even like, so I have the chief investment officer title. Like, you don't usually see that in venture capital firms either. And that's that's intentional based on how we are a different type of shop. So my colleagues, the co-founders, the managing partners of the firm, Dave and Travis, they met about 25 years ago in college. So they both went to Boise State. They're both lifelong Idahoans. And they essentially created Capital 11 14, 15 years ago to formalize kind of side investments that they were doing together. And it was never intended to kind of grow to what it's grown to. It was more like passive mailbox money. Let's just kind of make some investments and then monetize those. But it's grown into what I kind of like to call a pseudo family office, in that we just moved into our building. So if you come to Boise, like there's a Capital 11 building here, and we just moved in a month ago. So we have 25,000 square feet. We're at the top of the building, the top floor. There's only like 55 of us. So we have way too much space. We have more space than we need. But we have, of those 55, 50 people are working at our auto loan fund. So we have this auto loan fund that's been over the years generating excess cash flow. And then rather than like pocketing that money, the strategy has been redeploy that into venture opportunities. So we actually just made an announcement yesterday that we made our 40th investment, so our 40th portfolio company on the venture side, but we don't have LPs. So it's not a traditional venture fund. What I like to tell people is because of that, we're not beholden to investors. We can color outside the lines if we so choose to. But that's kind of it is different because we have this auto loan fund. We have this venture portfolio of companies. We also have a real estate fund as well, which is more traditional, where we have LPs and we're deploying capital that we raise. And then on top of that, given my background in doing private equity in Seattle, we've created a new vehicle to start acquiring companies here in the Treasure Valley. So we're unique. We're lean on the investment side. So there's the two co-founders. There's me as the CIO. I have an associate who reports to me, and I'm in the throes of interviewing interns right now for the summer. So we'll continue to probably build out the team on an associate intern level, but we definitely operate lean in that regard.
Okay. Now, tell me if I'm correct in this assumption or not, but the capital that you're investing is in part because of Dave and Travis's success with the startup several years ago. Is that correct? With the company that they started?
Well, it's the company they've started is Capital 11. So it's more of a direct success with the auto loan fund and how that's grown and ballooned over the years. So once again, the excess interest that's been kind of generated from that has been redeployed. We do have it's unique because we do have opportunities where sometimes we allow people to kind of sidecar along with us. Yep. So we could create an SPV for a particular opportunity, because we're getting folks all the time that essentially want to be our LPs. They're asking us, like, will you raise a VC fund? Oh, you're starting to acquire companies. Will you raise a PE fund? And we have those internal conversations all the time. We've kind of designated folks as friends of the firm. So I think if we were to kind of create a vehicle to deploy other people's capital in a more intentional way, we'd not do a big roadshow. We'd not try to raise, a 50 or $100 million fund. We'd kind of keep it tight, maybe 5 to 10 million, and we'd probably keep it within kind of our inner circle.
Okay. I guess the point I was thinking I was trying to convey is that the founders of Capital 11 started a loan fund or a business several years ago that's been highly successful, that's enabled them to then fund other companies. And if I'm correct in that assumption, they are aligned with the challenges and opportunities, and they understand what it takes to grow a successful business.
Yes, I mean, that's another, we would never consider ourselves professional investors. Like all of us have kind of sat in that seat as being an entrepreneur ourselves, or having been close, just being business folks. Like we have a high business acumen, I'd say. The fact that they're both lifelong Idahoans. Of our portfolio, 70% are here in Idaho, and the rest are kind of smattered throughout the country. But we certainly have an Intermountain West focus, and we understand the plight of an entrepreneur as well. So I think every VC wants to call themselves entrepreneur friendly,
Yep.
but like we really do mean that when we say like
Yep.
we're doing safes 9 times out of 10. We want entrepreneurs to be able to minimize their legal costs.
Yep.
We really want to come alongside folks and just be good guys and help however we can add value.
Yep. I just say from my perspective, it's really helpful to work with investors that have started a company and they've been there, they understand the challenges. But moving on from that, so we talked about you're starting to talk about kind of your geographic investment focus. What else? What are the other criteria? What else are you currently looking for that's kind of in the bullseye of your criteria?
Yeah, I mean, we do view it as on every opportunity standalone, like, does this have the potential to return the fund is kind of a common adage that VCs use. So there needs to be that opportunity for any one investment to be a home run for us, at least on the venture side. As we start, I'll segue on this a little bit, but the kind of rationale for us to start acquiring companies is to use it like a barbell strategy. So on one side, we have these 40 portcos that are mostly tech, all early stage, kind of a 5+ year time horizon before we monetize. And we're going to continue making those investments. But on the acquisition side, it's actually just the opposite. We want to counterbalance that. So it's to buy boring, stable, operating, cash flow generating companies. So on the venture side, we certainly are looking for companies that are typically seed stage. I mean, that's center of the strike zone. Sometimes we've come at the A round, sometimes we'll do pre-seed, but it's nice when there's been at least some sort of traction, some sort of product market fit that somehow has been created, or at least can be articulated to us. We typically, like our check size at this stage, we're coming in between $250,000 and $1 million. So that's a recent change. We were telling folks that we were between $100,000 and $1 million, but we found that more and more of the $100,000 investments we were making was because we didn't have strong conviction, and we're just like, we'll just do 100. So we're like, if it's not good enough for us internally to put 250 in, then it's probably a pass. So I think that's a good change that we've done.
Yep.
We're not actively seeking out Idaho per se, but just because I think we can claim to be the most active VC in the state. So we're seeing all the deal flow, which is great. We have kind of a company rule that if you are headquartered in Idaho, we're going to hear your pitch, even if you're a coffee company or just a rando company that wouldn't fit our thesis. We are going to hear your pitch to be able to be helpful, and because we're very big on kind of rising tide lifts all boats. So we want to help Idaho companies, but we're opportunistically looking at any company. So seed 250 to $1 million. We don't have any sort of formulaic way to say, hey, we want to own X% of the company post our investment. I know some VCs have that. We're not rigid in that way at all. And just from a sector standpoint, we are tech focused. We don't have like a subsector per se that we're only focused on, but obviously SaaS is something. B2B SaaS tends to be a sweet spot. We've done some ag tech deals as well. We've done a couple hardware deals. Once again, we try not to be overly myopic. We really are looking opportunistically in tech type of deals. And the adage, like a lot of other investors say, we're really betting on the jockey, not the horse. So we have to understand the entrepreneur's vision and the business model and the value prop and all that stuff. But really, for an early stage company, you're betting on the founder and whether they can execute on their vision.
Yep. And for the founders that are on the phone here or on the call here, when you evaluate a founder, if you were to kind of give advice or guidance to someone, what are the signals or the things that you look for in a founder as you vet them out to see if they're a jockey that you want to bet on?
Yeah, that's fun. We don't make founders like do a survey, those types of like personality or Myers-Briggs or anything like that. Really for us, it's a function of competency, It's a function of domain expertise. Like everyone talks about product market fit, but there's also like founder market fit. So does that background of the founder kind of mesh? And that goes back to can they execute on their vision? And that's not to say that we don't invest in like first-time founders that maybe they're entering an area that they don't have a deep background in. Like that's not a deal killer for us at all, but it's something we evaluate. I'd say too, we just, at this early stage, we're going to be spending a lot of time with those folks, especially because of the fact that we want to be adding value. So I think the collegialness of it is important, but also the coachability. Like those are things that it's this balance of we want someone to be confident but not like overly headstrong.
Yeah.
And it's something that through our interaction, sometimes that kind of just becomes obvious. That's like, hey, this could be a good idea, but maybe it's just not the right fit, and that's okay. Like I think we have pretty good relationships with all the folks that we pass on, because once again, we want to be helpful. And there are people on this call that we've said no to, and we really do want to be a resource. So we mean that when we make introductions, or we really are all about a rising tide lifts all boats. And we feel that part of our thesis for Boise in particular is that we're maybe 10 years or so behind Salt Lake. And we feel like the trajectory is in the right way and the flywheel is going, and we just want the area to be successful. My colleagues, as being lifelong Idahoans, want that. Even though I've only been here 18 months, like I'm not planning on leaving. I hope my kids have their families here. So we're just, we're very pro Intermountain West.
Good. I'm gonna make one comment on what you just said, then I'm gonna ask Chris Whalen, who just presented a question, to pose his question. But evaluating founders is really very difficult, particularly a first-time founder, because you don't really have a lot of evidence or tangible things to look at. But one thing that maybe founders may not recognize is just how you communicate with a VC in the due diligence process tells a lot. Are you persistent? Do you keep asking them, hey, what more do you need? When's the next meeting? Can I fly down to see you? Can we schedule a call? Those sort of things telegraph to me that, this person, if they're out selling, knows how to sell. They don't just sit back. Do they follow through on a timely basis? Are their presentations organized and well-researched? And those are really kind of the clues I get when I'm evaluating a founder. I often say that, I might ask a question, but frankly, how you answer the question is more important to me than the answer to the question. Have you thought about it? Are you being respectful? Are you coachable? So anyway, I think there's kind of one little nuance that we're judging you and just how you communicate as we vet you out. But with that, Chris Whalen, you have a question?
Yeah, Brian, thanks for making time. I can attest as a first-time founder, startup, early stage startup. I've had the opportunity to meet with Capital 11 down their Boise location, and I can say that they are definitely guys who really care about early stage startups. They care about the founders. They care about being able to give back to that startup, even if it's a no. And so just kudos to you guys as far as, having that character and integrity when you do meet with startups. The question I had for you, Brian, was one that I think might benefit early stage startups just in how the economy is changing. How has Capital 11's position changed with the change of the economy in how you evaluate, look, and decide on startups that you're going to potentially invest in?
Yeah, that's a good question, Chris. So there's a few answers to that. So one is that we used to, going back a little bit, when I first met the guys a little over a year ago, we had 18 portfolio companies. So in the last year plus, when a lot of investors have been sitting on their hands, we have taken a subversive counter-cyclical approach. So we've been writing checks. We're at 40 now. I don't know if we'll be at 50 by the end of the year, but I bet it rounds up to 50 if we haven't hit it. So we're not scared of the environment is kind of point number one. I think point number two is that we found that operating a little bit differently than like a traditional VC has been to our benefit in that being a little more regional focused too. Things never got super frothy from a valuation standpoint. So in Silicon Valley or in the East Coast, like a lot of those folks have pulled back because it's a natural reaction to kind of a little bit of a reversion, we could say. Whereas we never really felt compelled that we needed to pull back. We're looking at companies, we're evaluating opportunistically. But I would say, however, though, a change that maybe a recent change for the last 6 months for us is that we used to pride ourselves on saying that we're the first institutional check on the cap table. And I think I've kind of convinced the guys that maybe that's not necessarily the best thing. So there's something to be said with like external validation with other institutional investors. So even the last 2 investments we did, it's through the efforts of building and forging relationships with other VCs and family offices where we've came in on bridge rounds, but there were already like 3 or 4 VCs already on the cap table. And then they were the ones that brought us in. So I think that all that to be said, we wouldn't say no to an opportunity if there's not another institution on there, but I think we're being a little more selective and making sure that there are other co-investors on there that can help validate, the worthiness of that opportunity. And it goes back to kind of Tom's point, same thing too about being able to share notes on their take on the founders, their interactions with the founders as well, because this is not meant to be in an echo chamber when you're making investments like this. Like it's very different than the private equity world. Like if you're acquiring company, NDAs, no one knows, confidentiality. There very few times there are co-investors. But in the VC world, we might as well use it to our advantage that there's multiple parties investing and be able to piggyback on due diligence and thoughts and all of those things. So that's just kind of top of mind, Chris, on some of the things that in the last year, our mind has changed.
Thank you. For the people who don't know Chris has founded a company in Coeur d'Alene, Idaho called Historic. That is, I probably won't describe it as well as Chris does, but essentially digitizing historical records. Fascinating company. Also have a question from Julian Guthrie. Julian, do you want to pose your question? And if you can, also just kind of give be sure to highlight your company as well, which is based in Hayden Lake.
Yes, Tom, thank you for hosting this. And Brian, nice to be connected. I'm the founder and CEO of a tech startup. We've built a suite of AI communication tools called Reflect AI. Reflectcoach.ai is our website. We're using we're using large language models and generative AI and training on one of OpenAI's models now. Just wondering what sort of tech is exciting to you, and if you've invested in AI-enabled startups.
Yeah, actually, the 40th one that we literally just announced yesterday is a company out of Salt Lake, and Patry is its name. The founder used to work at Qualtrics, and lots of other VCs on the cap table on that one. So that's a good example of they were already on there for the seed, and then there was a bridge round that we just closed yesterday, which is an AI company kind of figuring out ICP fit data, like unlocking kind of deal priorities and just using proprietary AI and kind of integrated generative solutions for deal insights is kind of their value prop. I think that, it's interesting, like what excites me. I think it goes back to being truly somewhat agnostic on the subsector of things. Like I'm more interested in a very exuberant, seasoned, well, season's maybe not the right word because I don't want to diss, first-time founders, but a founder that has an idea that has some traction behind it. And once again, we're seed investing, so we recognize that. So we're not thinking like, hey, we're not going to invest unless you have 3 million of ARR. But it's more about where they're at as a company, the stage, who they have behind them, than we're focusing on AI or only prop tech or ag tech. Like we're trying to find good companies in all those verticals is I think another way to say it. And we're to a point now where some of it too is we're looking at a little bit of a portfolio diversification standpoint. Like we have 4 prop tech companies. So the next prop tech company we invest in, it has to be meaningful because we need to make sure A, it's not competitive to our other portfolio companies, or B, we get to a stage where it's like, maybe we don't want to be too heavy into one subsector because I don't know what's going to be, the best. And none of us are pure technologists. So that's probably our deficiency as a firm. We're generalists, like we have financial acumen, we're business guys. I was an M&A guy, but we don't have that like deep tech expert. So we outsource that type of look to both other co-investors, or sometimes we'll have other firms kind of look under the hood, so to speak, on the technology. But I guess that's kind of me answering your question in a roundabout way, where I can't say specifically like, hey, this is white hot. We're focused on only doing this. Our investment thesis isn't as subsector focused.
I have a quick, that does answer. Thank you. I have a quick follow-up question. So how do you define traction? So is traction always connected to revenue, or can traction be, we've had, 1,800 people testing it out, and we have the, all of the data and the analytics and the data room and all of that to share. And we're heading into this partnership where we will have our first significant revenue. So where is it like, okay, wait until you have that, or traction can be defined in different ways?
It can be defined in different ways. And yeah, as I've said, we've done pre-seed deals too. Our largest first check we ever written was $1 million to a company that was pre-seed, and now they're I think they're around 3 or 4 million ARR. So that was a good one I'm glad we invested in that pre-seed, but it doesn't have to be revenue. I think to your point, like just getting either a fervent customer base or folks that are on freemium models. It really goes back to what is the pain point? What is the problem you're trying to solve? Have you done enough market research to prove that that's actually a problem that people want to be solved? Because we can create pain points all day long or solution statements, but if people aren't willing to pay for that solution, then it doesn't really matter, right? So how can you through evidence show, not necessarily through revenue, but just that you've done your research, that there's actually a business to be had there.
Mm-hmm. Great, thank you.
Excellent. Thank you, Julian. And Julian's quite humble. I met her for the first time a couple of weeks ago, and her background includes, I think, over 20 years as reporter for the San Francisco Chronicle, and she's authored 5 books. So very fascinating individual with a company that looks very compelling, and she's also presenting at the Spokane Angel Alliance next week.
Excellent. Excellent.
So Brian, one question for you. Given that we're both somewhat regional investors, we're not based in the middle of Sand Hill Road or Silicon Valley, the opportunities that we see, may not be billion-dollar businesses. One thing I find, and when I make an investment through my angel funds, I also kind of look at it, hoping that each investment can make the fund. But I think one thing that's maybe a bit different about me is, and I'd be interested in your take, is if I look at a company that may never be 100 million in revenues, and maybe not even be 75 or 50 million, but it's a company that otherwise meets a lot of the criteria, perhaps in a niche market, and I can still get a 10x or plus return, I will still look at that. Obviously valuation plays into it, but do you also look at it through that lens that it doesn't necessarily need to be 100 million in 5 years or $1 billion?
Yes, I mean, ideally we'd like to see that there is that potential opportunity, but it's not a deal killer for us. It really isn't, and that goes back to we don't have LPs, we don't have like a specific IRR hurdle that we need to hit on every single investment. That being said, we know the statistics that a good chunk of these are going to be zeros, unfortunately, when all is said and done. So we are certainly open to investing in a company if we don't think it could be a grand slam. If we think there's a higher probability that we could get a double or triple out of it, that's not something that we would explicitly avoid for sure. And it goes back to, I mean, I know we're talking VC, but it also talks like going back to our acquisition model too.
Yeah.
We've had one company that's kind of pivoting. They were a real estate media marketing company doing SaaS solutions, and they've pivoted now to printing trading cards. So they're doing college cards and doing an NIL angle to it. And it certainly wasn't the company that we had first invested in when we did that pre-seed investment, but now they're turning into like an operating company that's not going to have juicy multiples, but they're very likely to return a pretty good net income this year, even though they're no longer a tech thing. So our exit of it has changed a little bit, but it's just kind of how we shifted, I guess. If they're not able to capitalize on the NIL angle to make it somewhat of tech related, then I'd kind of bucket that into that operating company investment category that I talked about earlier.
Okay. No, as we talking about your investment criteria and founders and traction and some of those other things, when you see a company's financial projections, what are you looking for, and how would you advise a company to put together their projections in a slide deck? You know, do you just kind of shoot the moon and show a hockey stick? Do you show some just kind of gradual revenue? You know, what do you look for, and how would you advise somebody?
Yeah, I mean, the one thing we know when we see a projection is that it's not right.
Yep.
Right. So it's not going to be that. So it's less about, I mean, when I see a projection or a financial model, I like seeing how the founder thinks. And what I try to do is just ask questions about it and see how they answer, and how do they defend those assumptions? And as I poke holes, am I upsetting the founder? Are they feeling like attacked? But by no means am I attacking. I'm just asking questions, because that then translates into, as prospective clients are asking them questions, how are they going to react? As other VCs are asking them questions, how are they going to react? So I enjoy those financial conversations to be able to understand kind of the cost drivers, the key assumptions that were created from that. And sometimes there really isn't. Like sometimes it's kind of thrown on a wall and it's kind of, well, it's just going to happen. And then that's obviously a big red flag, because anything that an entrepreneur puts in front of me, I want to be able to have a robust dialogue with them. And if they haven't put much thought into it, if question number one, they're like, I don't know. It's like, well, you should probably go back to the drawing board on this. Because I say that in a way, because a lot of these conversations we have too, to my earlier point, we are the first VC they've ever talked to. So we're never mean or cruel or like, just I actually think that's one of our deficiencies as a firm. Like, we don't have that a-hole on the team. Like, we're all nice guys. Like, you kind of maybe need that person, but we don't have that person. And I won't step into that role too, just so you guys know. But anyway, we see a lot of founders that maybe aren't ready to have that institutional pitch conversation yet. And that's okay, because that's another way we feel like we can add value to say, hey, you kind of missed the boat on X, Y, and Z. Here's how we think about it. You know, this isn't right for us to invest at this time, but make those changes. You know, maybe your next stage, come back to us and we can talk. And even if we never fund them, even if for us it's not an investment, that's a way that we really feel like we can give back and help the broader entrepreneur community.
Yeah. So it's not okay just to say, hey, you only need 2% of the market to be successful.
Yeah. That strategy, it just doesn't like, I get it, and I get why it's appealing to be like, if we just get a sliver, but we just need to, I want to understand how numbers tell a story, right? I'm a finance guy, and being an investment banker too, I'd have to be on the opposite side of that. If I had a client that was selling, it wouldn't just be about the numbers. It would be about how do you articulate, how do you craft the narrative of those numbers? So that's what we expect our founders to be able to do. And I guess that's another red flag. I don't think this is probably apropos or that relevant in early stage, but anytime a founder outsources, a CEO founder outsources the the capital raise to someone else, that's a big red flag, because we want to hear directly from that founder. I don't want to hear from their CFO. I don't want to hear from an investment banker they hired. There's time and a place for that. Usually I view it as the B round and beyond, where it's maybe okay for them to hire an investment banker. But if it's a pre-seed, seed, small Series A, then I want to get to know the founder, and I want them to be the one pitching us.
Yep, absolutely. My view is I like to see projections that are really well thought out. They're bottoms up, and they're supportable, and I would say reasonably crazy. It shows someone who's a big thinker, because we don't want to invest in plotters. We want someone who's a big thinker, but their projections, you go, okay, yeah, these are well thought out, and if this happens and this happens, they could actually meet these. But it's kind of a subjective zone. But if you're able to defend what you put together, and again, they're kind of reasonably crazy, that's where I kind of try to point people.
Yeah, and I'd say too, once again, we're not antagonistic as we're asking questions, but if it becomes really obvious if a founder has thin skin at that point, and it's just, once again, that's a red flag, because we're just asking questions. I'm just trying to understand how they got to that model, and so just punctuating on that.
Well, let's transition to how you source your deal flow. And one of the people here on the call, Robert Hager, has a specific question for you. Robert?
Yes, I'm here. I'm Bob Hager. I'm president of Prevail Technologies, and we are developing a method to improve cognitive function, people with dementia in the home, using AI-supported neurofeedback. That means we have a headset that detects brainwaves, and AI detects those patterns that are associated with memory and recall and formation. And then the music volume that they're listening to increases when they're generating those patterns. My question, Brian, is what is the best way to, what information would you like to have in an initial contact that would lead to a successful decision to see a pitch or hear a pitch? What do you like to hear from an entrepreneur?
Yeah, thanks, Bob. I appreciate that. And I anticipated that question by typing in my email in the chat box. So I think that there are some VCs that they're kind of prissy, and they're like, well, if you didn't impress me with that email, I'm not going to listen to your pitch and all that stuff. So once again, we don't operate that way. So the easiest way for someone to contact us would likely be emailing me. And it could just be a matter of, sending the deck over, asking for a call, a Zoom call. I mean, we're at a stage now where we're certainly hitting somewhat of bandwidth constraints, but I'd imagine, I think I'm probably bringing in more deal flow than the remainder of the team. And that's just a function of me being a new guy in town. It's like, hey, this was a once in a lifetime move for me. I'm just going to get out and kind of shake trees and unearth opportunities and build relationships. So I have traditionally been the guy that's not been the gatekeeper by any means, but at least an initial point of contact. So sending decks to me, reaching out over email, connecting on LinkedIn, that's probably the easiest path.
Okay, thank you.
Tom, do you want me to just broader talk about our how
Sure.
we're the deal flow? So it really is a kind of, I guess with Treasure Valley companies, since we are so active, I feel like if they don't know about us, then, I mean, anyone worth their salt should be contacting us on the Treasure Valley side. So I don't feel a certain amount of angst about I hope we don't miss this opportunity. I feel like we're seeing a vast majority of the deal flow here in the Boise area. For outside of the region, it really is just as we raise our profile as a firm, I think been helpful. So when I met the guys, a little over a year ago, they weren't patting themselves on their back. There wasn't a big like out there, like, look at what we're doing. They're just heads down working. And I appreciated that. I appreciated the kind of how subtle they were. But as we continue to invest and now hit 40 and are building up, like you can only be under the radar so long. So I feel like I'm trying to kind of somewhat be the ambassador for the firm in building relationships with ecosystems like this, like Spokane, as well as getting out there and meeting the other VCs and family offices in Utah, Washington, Oregon, Colorado, Montana. So it really is now more so driven by investors sharing deal flow as we share our deal flow with them and they share with us. So there's kind of the grassroots effort here in Boise, and then just being plugged in with angel groups and other venture capital firms.
And then once you've got a company that has approached you and it looks reasonably compelling, what is your process to get to a thumbs up or thumbs down decision? And, kind of typically, how long would you guide people from an initial contact to a potential closing? What is that time frame?
I was just I was sketching this out my associate earlier today, because we're flow charting this process out, because as a team we're further defining this. And what we've been doing is having pitch days. So we've actually 2 days a month we've set aside for the whole team to be at the office and to have like a mini Shark Tank session where we have like 7 or 8 companies just pitch us back to back to back to back to back, whether in person or over Zoom. And that's gone okay in batching it up, but it makes for like the end of the day, it's like, wait, what did that person say? Or you can confuse and muddle things up. So I think for our efficiency standpoint, it's worked out, but our effectiveness, it hasn't worked out. So we've now kind of moved to more of a chance for us to kind of whoever brings in the opportunity, let's say, sussing out a little bit more before you throw it in the transom and have all 4 team members kind of hear that pitch. But then if that person views it as something that the other team should know about, rather than having all 4 of us at it, we're kind of setting up separate meetings, maybe based on availability. Maybe it'll be a one-on-one with me, maybe it'll be 2 people, because we found that if you have an hour with a founder and there's 4 of us, everyone has their questions, and if someone dominates for whatever reason, then the whole meeting went in that direction. So we're trying to kind of bifurcate it a little bit better. So different meetings, different conversations flowing, and then coming together as a team and kind of, frankly, from there having a go, no-go decision, or at least a stage to say, okay, we're going to enter like explicit due diligence. But for us, if we're sending a term sheet over, we're funding. So it's not meant to be a long, drawn out process. That to be said, though, let me quantify that. I'd say on average for the companies we invest in, it's probably 4 to 6 weeks initial conversation to us wiring money. So it's not a long process at all. But there are some that it's just maybe one of us, it didn't resonate, or we don't feel that the timing's right. So those people, we don't want to give a no to. So we hang around the hoop is what we say. It's to the extent of like, hey, the timing isn't right, but we're not closing the door. Like, keep us posted on what's happening. So that's something that I guess an entrepreneur, if we don't word that correctly, they could feel like we're stringing them along. That's not the intent at all. It's just to say, hey, we can't cut a check based on the facts right now. Here's a couple of things, like go out and get some more revenue, or bring another institution on the cap table, or execute on whatever vision you laid out in front of us. So we don't want to string along companies. We want to, I know the only thing better than a quick yes is a quick no. So on ones that aren't a fit, we do say no to. But there are some that we just hang around the hoop and we just like, we're just not there, but maybe one day we can be there. And we've had those where we've said no to them, and then 9, 12 months later, we've invested. They did what they said they do, and we've invested. So we're not trying to, tease anyone along by any means.
Yep. And in this market environment, when companies are trying to determine how much to raise, how would you guide them to come up with that number?
Yeah. So, I mean, if you ask, I think, a dozen VCs that question, you're going to hear a dozen different answers. So this is maybe more style over substance.
Yep.
But I mean, the last thing that an investor wants to do is to invest in a company, and then 2 or 3 months later, they're running out of cash, right?
Yep.
So I would say a minimum of 12 months of runway. And probably what you view as 12 months of runway, you need to assume that's 18 months in reality, because things end up taking longer and costing more than what you're projecting. But there is something to be said, and I understand the entrepreneur's dilemma, and you don't want to overraise and have a too big of a dilution hit at an early stage too. So there is kind of the needle to be thread there. So yeah, I typically advise 12 plus months. We like to see that. Usually 18 is good. I think too, it gets harder. Like sometimes we have investors that are just loath to give up equity and dilute, and it's like, hey, it's a matter of both putting accelerator, just putting gas on the fire. But if you really want to execute on your vision, you're going to need capital, and you need to make sure that it's stage appropriate capital. Like you get your friends and family around, and that can be the Wild West. And then obviously as angels, that's not quite the Wild West, but it's a step up. But then as you're getting more institutions on the cap table, we have minimums that we want to deploy. Other VCs have certain amounts of equity or that they want to own post investment. So it's just being mindful of not overly diluting. So when you do get to that A, you have nothing left as the founder. And that's kind of a tough spot to be in, where you've diluted so much, or you've stacked up these safes and didn't realize how many safes you've been having. So when you get to the A round, you as the founder have a very small percent of the company. And that's not good for anybody. It's not good for you as the founder, but it's also it's a risk factor for the investors going forward, because there's not a big pull on you staying at the company going forward if you don't have a good chunk of equity.
Yep.
So,
hey, Chris Whalen, you had a question about how their investment criteria may have changed over the last 12 months. You want to ask that?
Yeah, I think the bigger question I had there was, so Brian, when you say you invest in a startup, where do you feel that Capital 11 has the biggest strength to help that startup succeed after the investment round?
Yeah, I think that there's a few things of that. And I didn't mention this actually earlier, so thank you for bringing this up again. So we have both an in-house counsel, so we have a general counsel, and we have an in-house CFO. So we view them as we view ourselves as service providers, frankly. We're providing the service of capital, but we're also providing the service of our in-house capabilities. So those are things that we suggest that our founders lean on us to be able to assist in those things. As I mentioned, we all have kind of an operator background or have financial acumen. So we'll help when it comes to just building out financial models or furthering the business model further. Really, though, we're using our collective network as well to be able to make introductions to other investors, to potential customers. And that's where I think a lot of VCs just say, hey, we love making intros, and some do and some don't. But we really are adamant about being able to kind of put our cards on the table and make the introductions of our networks to be able to move the ball for some of these companies. So that's, I'd say, the financial acumen, the in-house CFO and general counsel, and then the just kind of the introductions we make. And then sometimes we'll take a board seat, sometimes we won't. It just depends. But really, we want to be the strategic sounding board for the entrepreneur founder. And what we like to say, I'll close on this kind of that question at least. We like to say is that, I mean, sure, there's monthly calls or quarterly board meetings, but really the value is had at taking that, that call at 9 o'clock, having those 10-minute conversations here and there when there's like an urgency that's needed. That's what we, I think, excel at. And, the adage is, VCs are out there hunting for unicorns, but we like to say that we're raising and nurturing unicorns. And that's just a part of it. It's having communication, it's being there for our portfolio companies and helping however we can.
Speaking of unicorns, David Heath has a question. And David, I failed to mention at the beginning, but is another company that is raising capital and presenting at the Spokane Angel Alliance next week. And he's got a new company. David, you want to pose your question?
Yeah, thank you. And thanks for this whole symposium. It's outstanding. So Brian, have you guys been involved at any healthcare startups? Knowing that, healthcare is it's 20% of GDP, but it kind of has its own gravitational pull and ecosystem.
Yeah, no, it does. And we found that with healthcare, it's not something that we've actively sought out, just because with our chance to be value add partners, we don't have as many opportunities to assist. With that being said, we didn't invest in a company called Prescription last year, and that is a company out of Sun Valley where they're basically working with self-insured employers, just with providing the prescription drug benefits. So replacing the PBMs, the pharmacy benefit managers. With that being said, though, I think it's going to be a winner, but when we talk about adding value, we haven't really added much value in that one, in my opinion. There's now Health Care Tech Idaho, or there's some group that's just trying to get started out to get more visibility. And I don't think it's only Idaho specific, but I think they're trying to build up maybe a community similar to this, Tom, to get more of a spotlight on healthcare. But yeah, David, it's been something that we haven't been as aggressively pursuing, just because of our lack of experience in the industry.
Thank you.
Okay, nonetheless, we're going to send you David's plan because it's pretty unique and it has unicorn opportunities. Only a couple more minutes here, and Chris kind of has an interesting question. Chris, do you want to ask Brian what you put in the chat room?
Yeah, thanks, Tom. Thanks, Brian. This has been super interesting. I appreciate it. I'm sorry for last minute question. And in hearing about how you're describing your team internally, just curious as to if you see an investment start to go sideways or not play out how you had planned. I know it could be different for every company, but what's your general process and approach for helping those companies out when they're not panning out the way you had hoped?
Yeah, no, that's a really good question. And
probably never happened to Brian.
It is happening currently. We're dealing with some of those. Yeah, I mean, we're in a unique spot where we have a young portfolio. So the average age of our investment is probably 1.5 years. So because of that, we have not had a company go out of business yet, which I think is incredible, having 40. But on the flip side, we also haven't had an exit yet. So I'm not going to pat myself on the back too hard with those metrics. I think that we're going to see this year companies that probably are hitting a wall and will have to make a decision to either shut down or kind of have an M&A event where they're sold for, we'll say, pennies on the dollar. So I think that we're going to see more of that in our portfolio, and we're going to see it in general across the VC landscape. I guess going back to the value add we bring, since I have an investment banking background, I have my finger on the pulse with how that goes down, or who to bring to the table, or negotiating those types of terms. But I would rather a company exit that way and at least get some capital back and have a story to tell than an out of business. So I think that for us adding value, we're shepherding some of those maybe inevitable zeros to actually be a winning outcome, all else being equal, given our background in some M&A events. I think for the ones that there's no suitor, it's just you're rolling up your sleeves and trying to help, but we're not going to throw good money at bad money. So that sounds harsh, but you do reach a point where it's the there's not there. We made the investment, things didn't materialize as we hoped, and it's just gonna, the inevitable outcome is gonna happen as it needs to happen. So it's a really bad way to end this, right? It's on a down note, but that's just kind of the reality of the situation we're in. I think too, the stats say 75% or so of companies, startups will fail. I actually think that our number will be better, but probably every investor thinks that. I think that we're going to have a 50-50 hit rate. I think 50% of our companies at the end of the day will return capital, return a positive investment for us. when all is said and done. And some of that is because we're all here in the Intermountain West. And Tom, I don't know from your portfolio what you've seen, but I think that avoiding the coasts is probably to our all collective benefit.
Yep. I tend to think that we're investing in a region that is kind of underserved by investors, with some kind of, unique opportunities and favorable valuations that don't necessarily swing with the market environment. So it's a more consistent form of investing is kind of my viewpoint. But well, we're 1 o'clock, and so I want to be respectful of everyone's time. But I think this was a tremendous discussion. I know personally, I only got through about half of my questions, so it was great to see questions from the group. I also had kind of telegraphed to Brian to maybe only expect 20 to 25 people on the call, so we got great attendance. I hope everybody found it to be valuable. Since I'm doing something similar to what Brian is doing, but in the Spokane, Coeur d'Alene, and Sandpoint region, it's great to have the chance to talk to someone that is kind of viewing the world in the same way I have. So Brian's put his email address out there. So if you have plans or ideas, please reach out to Brian, and hopefully we'll have him teed up to do another one of these events sometime in the near future. And then finally, before I conclude, I just want to thank the team from Hawley Troxel for being great sponsors of Ignite and for participating in this.
Thanks, everyone. Appreciate you having me. This was great.
Thank you. And thanks, everyone else. Enjoy a sunny afternoon here in Spokane.
Thanks, Brian. Thanks, Tom.
Thank you.